The 400 ad that created millionaires. In 1983, an unusual advertisement appeared prominently in the Wall Street Journal. It wasn't promoting some flashy stock tip or a flashy get-rich-quick gimmick. Instead, it offered something far more profound, something that would fundamentally transform the world of trading forever. Richard Dennis is now accepting applications for the position of commodity futures trader to expand his existing group of traders. Mr. Dennis will personally teach his proven trading methods to all successful applicants. Those chosen will then trade exclusively for Mr. Dennis. They will not be permitted to trade futures on their own behalf or for others. Successful traders will receive a percentage of their generated profits and will also be allowed a modest draw against earnings. While prior experience in trading will certainly be considered, it is not strictly necessary. Applicants were required to submit a resume and, in 10 words or fewer, answer one simple yet revealing question: what makes you tick? More than 1,000 individuals responded. Among them were investment bankers, taxi drivers, professional blackjack dealers, accomplished PhDs, and even high school dropouts. Each one harbored the same dream: to learn directly from the legendary trader who had transformed a modest 600 into an astonishing 200 million. 23 were ultimately selected. Within just 4 short years, these individuals had collectively earned more than 100 million in profits. One standout was a 19-year-old named Curtis Faith, who personally earned 5 million before turning 24. Another was Jerry Parker, a reserved accountant who would go on to manage billions of dollars in assets. Then there was Liz Shevel, one of the very few women in the group who achieved financial independence and retired comfortably at age 45. Mike Carr, who had previously earned a modest government salary, turned those lessons into lasting generational wealth. They weren't born with extraordinary genius. They weren't naturally gifted traders from the start. They were ordinary people who became known as the Turtles. The story you are about to explore in greater depth is the ultimate real-world case study in the power of discipline, and it lies at the very heart of what we emphasize here at Trading Psychology, STIC, discovering and applying the mental models that genuinely produce results. However, because true mastery of trading psychology begins with accepting complete personal responsibility, please always keep in mind, this is intended purely as an in-depth educational exploration and not as financial advice of any kind. Trading carries substantial risk of loss. Now, let us dive deeper into the secret that made this extraordinary outcome possible. Everything truly began one evening in a quiet restaurant in Chicago. The $1 million bet: are traders born or made? Section 2 in THE-ML-R-B. Imagine the scene: Le Colonial Restaurant, Chicago, 1983. Soft jazz fills the air. Expensive wine is poured freely. Two close friends are locked in a passionate debate about the very nature of extraordinary success. Richard Dennis, only 34 years old, is already a living legend. He began with just 600 borrowed from family members and grew it into 200 million. The trading pits nicknamed him the Prince of the Pit because he could move entire markets with a single bold order. Sitting across the table is William Eckhart, his longtime friend and trading partner, a brilliant mathematician and accomplished chess master. Eckhart is absolutely convinced that Dennis is wrong. Trading simply cannot be taught, Eckhart declares emphatically, tapping his fork on the plate for emphasis. You either possess the innate gift or you don't. It's exactly like having perfect pitch or world-class athletic ability. Dennis smiles calmly. He has heard this argument countless times before, from envious brokers guarding their secrets, from academics who have never risked real money on a trade, from everyone who desperately wants to believe that great success is rare, mystical, and unattainable for the average person. Bill, I could take literally anyone off the street, anyone at all, and teach them to trade exactly the way I do. Trading is a learned skill, not some mysterious inborn talent. That's nonsense. Eckhart fires back. You're a genuine savant, Rich. You perceive patterns that others completely miss. You feel the subtle rhythms of the market that escape everyone else. That kind of intuition simply cannot be taught. Dennis leans in closer. Want to make a bet? How much? Let's do something even better than money. Let's wager our reputations. I'll prove once and for all that great traders are systematically made, not magically born. The bold experiment that followed would shatter nearly every widely held myth about what it takes to succeed in trading. But first, Dennis and Eckhart had to find their unlikely students. As you read this, notice how your own mind is already quietly taking sides. Are great traders born with rare gifts, or can they be carefully trained? Hold that question gently as we reveal exactly what happened next. The bizarre selection process. Section 30 TE CLTO, CPOS and Ordina ARPO, applications poured in by the hundreds, then thousands. Doctors wary of the medical grind. Lawyers disillusioned with endless litigation. Gamblers searching for a legitimate outlet for their risk-taking instincts. Housewives seeking genuine financial independence. Dennis and Eckhart spent weeks carefully reviewing every submission. Yet they were not searching for the credentials most people would expect. I don't want candidates with extensive financial experience, Dennis told his assistant firmly. I want clean slates, individuals who can follow clear instructions without being weighed down by their own preconceived ideas and bad habits. The selection criteria were deliberately unconventional. Could the applicant emotionally handle being wrong roughly 60% of the time? Did they truly grasp probabilistic thinking rather than chasing perfect predictions? Were they comfortable adhering strictly to rules instead of relying on gut intuition? Could they execute a trade decisively even when fear was screaming otherwise? One single question eliminated more than half the applicants. If you had a 55% probability of winning Fund 1000 versus a 45% probability of losing Fuzz 100, would you accept the bet? The majority answered no. They fixated on the potential loss rather than recognizing the positive mathematical expectancy over time. Dennis sought only those who confidently said yes, those who intuitively understood that long-term profitable trading requires embracing carefully calculated losses. From well over 1,000 submissions, only 40 advanced to in-person interviews. Michael Cavallo, 31, was a government auditor who had never purchased a single stock in his life. I appreciate clear rules, he said plainly. Give me the rules and I will follow them precisely. Jerry Parker, 33, a soft-spoken accountant from rural Virginia, explained his motivation simply. I'm tired of building wealth for other people through random salaries. I want systematic, repeatable wealth creation. Curtis Faith, just 19 and the youngest applicant by far, immediately stood out. A self-taught computer programmer, he told Dennis, trading is essentially just code execution, if-then statements with real money at stake. I know I can master that. Liz Shevel had previously worked as a trading assistant, watching men make fortunes while she handled administrative tasks and fetched coffee. I know deep down I can do exactly what they do, she said with quiet conviction. I simply need someone willing to teach me properly. Jim Melnick, a sound engineer at a recording studio, answered the question, what makes you tick? With solving complex puzzles that no one else can figure out. After exhaustive and often grueling interviews, 23 candidates were finally chosen. They had no idea yet that they were stepping into the most intense and transformative educational experience of their lives, 2 concentrated weeks that would turn minimum wage earners and ordinary professionals into multimillionaires. Dennis nicknamed them Turtles after visiting turtle farms in Singapore during a trip. We're going to grow traders the same way they grow turtles in Singapore, slowly, methodically, and with perfect systematic care. Feel that rising mix of excitement and healthy skepticism. That is precisely how the turtles themselves felt as they walked into their very first day of training. Day 1, everything you know is wrong. Section 4's in DAY-ONE, Eva Ryan Ice Davaran, January 2, 1984. Chicago Board of Trade Building. 23 anxious individuals gather in a large conference room. Richard Dennis enters confidently. Forget absolutely everything you think you know about markets. He begins without preamble. Your personal opinions are completely worthless. Your predictions are meaningless noise. Your intuition is actually your worst enemy. The room falls completely silent. This is not at all what they expected from a legendary trader. We are going to buy strength and sell even higher. We are going to sell weakness and cover even lower. We are going to lose money on roughly 60% of our trades, and we are going to become extremely wealthy doing it. Michael Cavallo tentatively raises his hand. But isn't the universal goal to buy low and sell high? Dennis smiles broadly. That is exactly what nearly everyone believes. And that is precisely why nearly everyone loses money over time. We are not long-term investors hunting for undervalued bargains. We are disciplined trend-following traders. There is a profound difference. He turns to the large whiteboard and writes in bold letters, T Kampi Partiel, Tiardaim Swastem. This is literally everything, he declares. The entire system that turned my FERD 600 into 200 million fits right here on this board. Entry rules, system 1 enter long on 20-day breakout high. Exit on 10-day breakout low. System 2 enter long on 55-day breakout high. Exit on 20-day breakout low. Pyramid by adding units at each additional zero. 5N profit increment. Exit rules, initial protective stop 2N. Final exit on 10-day or 20-day reversal opposite the position. Never under any circumstances move stops away from the current price to increase risk. Position sizing, unit size 1% of current account equity divided by. Markets to trade, any highly liquid market, bonds, currencies, commodities, stock indices. That's really the entire system. Jerry Parker asks, incredulous? That is absolutely everything. Dennis confirms. But understanding the recipe does not automatically make you a master chef. The crucial difference between future winners and perennial losers is not superior information. It is flawless execution over time. Curtis Faith scribbles notes furiously. What about fundamental analysis, economic reports, breaking news events? Completely worthless, Dennis states flatly. The market price has already discounted and processed every piece of available information far better than any individual ever could. Current price action tells you everything you truly need to know. For the next 8 intense hours, Dennis systematically dismantles every popular trading myth the group had ever absorbed. Technical indicators, little more than tea, leaf reading in modern astrology, fundamental analysis. Convenient stories traders tell themselves to justify otherwise random price movements. Predicting market direction? Not only impossible, but entirely unnecessary for long-term profitability. Discretionary judgment trading, merely ego masquerading as sophisticated strategy. By the end of that first exhausting day, the turtle's previous beliefs about markets had been thoroughly demolished. Yet Dennis was far from finished. Tomorrow, he announces as they pack up, we will explore the true hidden engine of wealth creation, position sizing, master that single concept, and you can be wrong most of the time and still build substantial wealth. Get it wrong, and you can be right far more often than average, and still eventually go broke. As you absorb the elegant simplicity of this approach, you may feel a subtle resistance rising within you. That resistance is perfectly normal. It is the same resistance that prevents 95% of aspiring traders from ever consistently applying what actually works in real markets. The position sizing revolution. Section 50. Teach Pasatalas is in Revolutuon. Day 2 begins with Richard Dennis entering the room carrying 2 briefcases. One of these contains the most valuable secret to building serious wealth, he says dramatically. The other contains the primary reason most traders eventually fail and go broke. Can anyone guess which is which? No one ventures an answer. Dennis opens the first briefcase. Inside are thick stacks of complex charts, dozens of technical indicators, and reams of fundamental research reports. This is what the vast majority of traders obsess over endlessly: entry signals and timing. It accounts for perhaps 10% of long-term success at best. He opens the second briefcase. Inside lies a single sheet of paper containing one straightforward formula. Position size TAPA. This single concept, he declares, is worth at least 90% of your eventual success. Proper position sizing is the most critical decision you will ever make, yet most traders give it virtually no serious thought. He turns back to the whiteboard to illustrate exactly why so many capable traders still fail. Trader A. The typical amateur, 100,000 account, strongly believes gold is heading higher. Buys 10 full contracts, conviction feels high. Normal volatility causes gold to drop 50 temporarily. Loss of 50,000. Trader destroyed. Trader B, the turtle, 100, receives objective systematic buy signal. Calculates proper unit size based on current volatility. Correct position 4 contracts. Same 50 drop. Loss only to 1,000. Trader survives comfortably and awaits the next signal. Identical market movement. Dennis emphasizes. One trader wiped out, the other barely affected. The only difference is disciplined position sizing based on volatility. Mike Carr raises his hand. But what if the amateur was actually correct and gold rallied strongly? Excellent question, Dennis replies. Let's examine that scenario as well. Gold subsequently rises 100, amateur falls 100,000 profit, gay account doubled, turtle tussin 4,000 profit, 4% gain. On the surface, the amateur appears to win big. But here is what actually happens across a realistic series of 100 trades. He presents the long-term mathematics that would forever change their perspective. Amateur random sizing approach, assumed win rate 50%, average win flow 100%, average loss 50%, result after only a few unfavorable sequences completely broke. A single large loss erases all prior gains. Turtle systematic sizing approach, realistic win rate 40%, average win for 10%, average loss 2%, result after 100 trades approximately 400% with far lower emotional stress. The amateur must be correct on direction timing and avoid every large drawdown. The turtle simply needs to show up consistently and follow the proven formula. Curtis Faith is completely captivated. So position sizing is essentially advanced risk management. No, Dennis corrects firmly. Position sizing is the core strategy. Everything else is merely mechanical implementation. He then introduces the crucial volatility measure that would generate millions for them, the average true range. Calculate the maximum of 1. Today's high minus today's low 2. Today's high minus yesterday's close 3. Yesterday's close minus today's low. Average over 20 days. Update daily. When sugar exhibits daily swings of 500 while bonds move only 300, do you risk identical dollar amounts? No. The class responds in unison. Exactly. You risk the same percentage of equity on every trade by dynamically adjusting position size according to current market volatility. Higher volatility demands smaller positions. Lower volatility allows larger positions. The market itself dictates appropriate sizing. Then Dennis delivers the decisive insight, and when a position moves in your favor, you systematically add to winning trades in predefined increments. As your mind instinctively tries to overcomplicate this elegant approach, recognize that reaction for what it is, your ego quietly defending the belief that success must be far more difficult than this. The pyramid principle, how to get rich on winners, section 60T Plaramipirai and CPLE. Who can tell me the absolute fastest way to go broke in trading? Dennis asks on day 3. Several hands go up, averaging down into losing positions. One suggests, very close, Dennis replies. The fastest route to ruin is repeatedly adding to losers, but the fastest legitimate way to build serious wealth, adding systematically to winners. We call this disciplined pyramiding. Confusion spreads across the room. This directly contradicts almost everything they had ever heard. Cut your losses short and let winners run was familiar advice, but deliberately increasing exposure to already profitable positions felt dangerously counterintuitive. Dennis draws 2 scenarios on the board. Traditional fear-based trader, price rises to 110, takes profit quickly out of fear of reversal, misses the subsequent move to 150. Turtle pyramiding approach. Initial 10 restrict 2% account risk. Price rises to 100 to 250, adds 8 more units. Price rises to 105, adds 6 units. Price rises to 107.50, adds 4 units. Total exposure 28 units when price reaches 150. Same initial risk, more than 5 times the eventual profit. That disciplined pyramiding is exactly how I personally turned modest accounts into hundreds of millions. Dennis explains. Jerry Parker remains skeptical. But what if the trend reverses after we have pyramided aggressively? Excellent. Let's examine the actual mathematics of controlled pyramiding risk. Initial entry. Protective stop at 98. Add 8 units at 102. 50 trail all stops to 150. Add 6 units at 105. Bay trail stops to 103. Add 4 units at 107. 105.50. If price reverses from 107.50 back to the trailing stop at 105.15. Original 10 units, fluffy 5 per unit profit. Second 8 units of the 30 profit. Third 6 units of the 5 profit. Final 4 units I-80 loss. Net result the 82 overall profit. Even the last pyramid layer lost money. The turtles sit stunned. The mathematics of pyramiding reveal that you can be wrong on several additions and still generate substantial net gains. This is precisely how the truly large money is made, Dennis stresses. Not by achieving a higher win rate, but by having significantly larger position size when you are correct. He pauses dramatically before the crucial warning. Pyramiding only produces magic during genuine sustained trends, and real trends are relatively rare, which means you will spend the majority of your time experiencing small, consistent losses while patiently waiting for the few massive trends that define your entire year's performance. The real question is, can you emotionally endure that reality? Notice any discomfort you feel at the idea of being wrong most of the time. That very discomfort explains why the vast majority of traders never manage to capture life-changing large moves. The first real money and the first big win. Section 70. 2 intensive weeks of training complete. January 16, 1984. Dennis gathers the group for the final announcement. Some of you will receive 250,000 trading accounts. Others will receive 1 million. A select few will receive 2,000 million. This is real money with real consequences. Lose it through poor discipline, and it is gone forever. Curtis Faith, still only 19, is stunned when Dennis pulls him aside privately. You're receiving 2 million to trade. Why me? Faith asks. Because you arrived with the fewest bad habits to unlearn. And because you asked the most insightful questions throughout training. The very first day trading live capital feels almost surreal. Jim Melnick later recalls sitting at his desk staring at glowing screens. I had gone from earning roughly 30 1,000 per year to controlling 1 million of someone else's capital. My hand was literally trembling when I placed that first live order. Initial results are predictably mixed. Week 1 summary 5 targets, 18 register losses. Average drawdown 1, 8%, largest winner, 32%, largest loser, 1%. Perfect. Dennis declares at the weekly review meeting, most of you lost small amounts. That is exactly what should happen during periods lacking clear trends, but theoretical knowledge and the raw emotional reality of live trading are entirely different experiences. From Michael Cavallo's private journal, week 2. Entered long soybeans on signal, stopped out. Entered Swiss franc, stopped out again. Entered crude oil, stopped out for third time. Down approximately 47,005 trading days. The entire system suddenly feels fundamentally broken. This period represents the first true psychological test. Will they continue trusting the proven system, or will they begin trusting fleeting emotions? Then February 8, 1984 arrives. Heating oil registers a clear breakout high. Every single turtle receives the identical buy signal. Their individual responses reveal everything about future outcomes. The disciplined and faithful take full calculated position sizes. Curtis Faith 15 contracts, Jerry Parker 12 contracts, Paul Barr 10 contracts. The fearful and recently shaken reduce exposure dramatically. Several traders only 5-7 contracts. 2 traders skip the signal completely. Heating oil explodes higher, rallying for 9-4-28 over the following 3 months. Results from that single trend, Curtis Faith 3, 2 million, Jerry Parker +1, 8 million. Reduced size traders plus 400,000 to 600,000. Signal skippers do dod profit and lasting psychological regret. At the quarterly review, Dennis drives the lesson home. Those who followed the system exactly made millions from one trend. Those who inserted personal discretion made thousands, or absolutely nothing. But this was merely the opening chapter. Far greater tests of character and discipline lay ahead. Feel the growing tension between cold logic and hot emotion, between knowing the correct action and actually executing it under pressure. That ongoing internal tension ultimately determines whether you end up wealthy or merely perpetually almost right. The Psychology of Systematic Losing. Section 80. Teach Peswai Sicholag, Offsweistamaka March 1984. The powerful heating oil trend ends. Now begins the far more difficult phase, the long grind of range-bound choppy markets. For the next 4 grueling months, nearly every breakout fails quickly. Monthly trade summary, March 23 trades, 19 losses, April 31 trades, 24 losses, May 28 trades, 22 losses, June 26 trades, 21 losses. I would wake up each morning already knowing I was likely to lose money that day. Paul Rabar later recalled. The accumulated psychological weight felt almost crushing at times. This extended drawdown period revealed the profound difference between intellectually understanding a system and truly living it day after day. Tom Shanks developed a small daily ritual to preserve sanity. Every single morning I wrote, "The system works long-term 10 times in my journal." It sounds silly now, but it kept me from emotionally unraveling. Liz Shevel adopted a different coping strategy. I stopped looking at daily profit and loss entirely. I would check open positions, place required orders, then physically cover the P&L column with tape. I only allowed myself to view final numbers on Friday afternoons. Yet not everyone held firm. David Shevel began subtly improving the system. This particular breakout doesn't look convincing enough. Skip. This market feels overly volatile. Reduce size. This signal conflicts with recent news. Skip. By July, David had selectively skipped 12 valid signals. His account was down roughly 8%, while pure systematic turtles were down closer to 15%. He felt temporarily vindicated. Intelligent judgment actually works better. Then August arrived. Coffee launched into a massive trend. Sugar rallied sharply. Currencies began trending strongly. David, having gradually lost faith, took the new signals only half-heartedly and made approximately 5% that month. The fully systematic turtles. Many recorded gains between 40% and 60%. Curtis Faith's August alone generated +7 million. David committed the classic error, Dennis later explained. He optimized his behavior to minimize short-term emotional pain rather than maximize long-term profitability. In trading, those two objectives are almost always diametrically opposed. But the deeper psychological challenges extended far beyond mere drawdowns. Unexpected success introduced entirely new demons. Jim Melnick found himself up roughly $2 million by September. I literally could not sleep, not from fear of losses, but from overwhelming gains. I had never possessed real money before. Now, I was earning in a single day more than my father earned in an entire year. The guilt and imposter syndrome became overwhelming. Thoughts like, I don't really deserve this. It feels too straightforward, and this luck cannot possibly last, plagued several turtles. Richard Dennis, having witnessed similar patterns before, addressed it directly in a group meeting. The market does not care about your personal feelings of worthiness. It does not know whether you deserve the profits. It only responds to whether you consistently followed the objective rules. Your sole job is not to judge your own worth. It is to remain rigorously systematic. As you read this, quietly examine your own internal relationship with deserving substantial success. That private relationship may ultimately matter far more than any external trading system. The $1 million mistake that taught everything. Section 90, The Malam Dalar Misty, September 12, 1984. Jim Melnick commits an error that will haunt him for years, yet ultimately teach him everything essential. I was calculating position size for Deutsche Marks. Current N was 0.50, account approximately 1-2 million. I made a simple multiplication error and entered twice the correct number of contracts. By the time he discovered the mistake, the Deutsche Mark had already moved adversely by 30 ticks. With double position size, he was losing roughly 15,000 per tick, total unrealized loss of 450,000. My immediate instinct was to close the oversized position immediately, accept the loss, and move on. But then I paused and asked myself, what would the objective system dictate? The system was unambiguous. The protective stop had not yet been hit. Therefore, hold the position. Those next 2 weeks were pure agony, Melnick recalls. I could barely eat or sleep while watching 4 to 50,000 in red on the screen, knowing the error was entirely mine. The other turtles observed with a mixture of fascination and dread. Would Melnick emotionally crack and close early? Day 100, Deutsche Mark stabilize. Day 125, small recovery begins. Day 421, clear breakout higher. The Deutsche Mark surges dramatically. Not only does Melnick fully recover the temporary drawdown, but the accidentally oversized position becomes his largest winner of the entire year, to 8 million. I got extremely lucky, Melnick admits today. But the deeper lesson was priceless. Even after committing a serious error, rigidly following the system afterward produced far better results than any emotional intervention would have. Dennis turns the incident into a powerful teaching moment. Jem made 2 separate decisions. The first was a clear mistake, incorrect sizing. The second was pure wisdom, continuing to trust the system despite the mistake. That second decision is what ultimately made him wealthy. Yet not every mistake ended happily. Philip Liu, an MIT graduate with a reported 180 IQ, made a different category of error. He became convinced he could enhance performance by adding sophisticated filters, only take breakouts accompanied by expanding volume, skip signals invisibly, overextended markets, reduce size when volatility appeared excessively high. Each individual filter seemed logically sound, Liu later explained. Together they should have produced superior risk-adjusted returns. Reality proved otherwise. Q3 1984, Liu for 12% vis pure turtles to 45%, Q4 1984, Liu to 8% vis pure turtles to 38%, 5% vis pure turtles to 27%. By April 1985, Liu quit the program entirely. I simply could not tolerate being the objectively smartest person in the room while producing the worst results. Dennis's blunt assessment: raw intelligence without ironclad discipline is ultimately worthless. Far better to be a highly disciplined average mind than an undisciplined genius. Do you feel that subtle urge to prove proven systems by adding your own judgment or common sense? Recognize that same urge has destroyed more trading capital across history than every major market crash combined. Black Monday, the ultimate test of discipline. Section Tane, THELTM Autist, October 19, 1987. A day that would define entire trading careers. The day global markets descended into absolute chaos. Tom Shanks arrives at the office at 7 a.m. feeling optimistic, up roughly 10 million year to date. By 10 a.m., his world is unraveling. The Dow Jones Industrial Average is not merely declining, it is crashing violently, 10%, 15%, 20% within hours. Phones ring incessantly. Brokers scream orders. Some traders are literally in tears. I was short S&P futures and should have been making fortunes, Shanks recalls. But futures went limit down, trading halted entirely. When markets reopened, the gap was so extreme that my protective stops were executed 50 points worse than planned. His P&L timeline that day: 9:30 a.m. flux 10 million YTD HENV. YTD 11:30 a.m. 2 million YTD close 3 million YTD. In a single session, approximately 13 million in paper profits evaporated. I went to the restroom and vomited, Shanks admits. Then I washed my face, returned to my desk, and calmly checked for any new valid signals. This unflinching response is what fundamentally separated turtles from nearly every other trader. Jerry Parker. Positioned differently, was ideally aligned for the chaos. Short stock indices +4, 2 million long gold FOV1, 8 million long Japanese yen FO2, 1 million long bonds E3, 1 million net result the 5 million on the worst day in modern market history. I felt like I was standing calmly in the eye of a hurricane. Parker later reflected. Panic everywhere, yet my system kept me grounded. Take signals, size correctly, manage risk, same routine as any ordinary day. The true revelation, however, October 20th, 1987. Tom Shanks sits at his desk down $3 million, ego bruised, confidence shaken. A new clear signal appears: buy gold. Every fiber of my being screamed, don't trade today. You just lost 13 million yesterday. Take time off, regroup. But the objective system said buy gold. Shanks executes the signal. Gold rallies approximately 8% over the next 2 weeks. Shanks recovers 2 million. By year end, he finishes up 3 million overall. If I had allowed emotion to pause trading after Black Monday, I would have locked in a permanent $3 million loss. By continuing to follow the system through intense pain, I ended the year strongly profitable. That is the day I truly became a complete turtle. The contrast with discretionary traders was stark. Most non-systematic traders remained paralyzed by fear and missed the violent post-crash trends that followed. Turtles continued taking every objective signal and captured substantial profits. Curtis Faith later summarized it perfectly. Black Monday was not a catastrophe for us. It functioned as a powerful filter, separating those who traded on emotion from those who traded on proven systems. Imagine losing an entire year's worth of profits in one session, then calmly resuming normal systematic trading the very next day. That mental fortitude is the ultimate difference between systematic wealth building and discretionary gambling. Where are the turtles now? Section 11 CT Tartella Despore. By 1988, the groundbreaking experiment concluded. Richard Dennis had conclusively proven his point. Great traders could indeed be trained rather than requiring rare innate talent. What happened next surprised nearly everyone. The turtles dispersed in multiple directions, each carrying the core DNA of systematic trend following into diverse applications. Jerry Parker founded Chesapeake Capital, raised substantial institutional capital, and built a fund that has survived every major crisis for over 35 years while managing billions. I eventually realized Dennis taught us something far larger than mere trading techniques. Parker reflects. He taught us how to design robust systems that function reliably even without constant personal intervention. That understanding is the true lasting fortune. Curtis Faith became the public face of turtle trading. Turtles demonstrated ordinary people can achieve extraordinary outcomes through rigorous systems. They illuminated the path clearly. Now it is your turn to walk it with purpose. Welcome to the enduring way of the turtle. Your transformation begins in 3 simple words. Day 1. Begins. The market is waiting patiently. Your systematic future is calling. All that remains is your decisive answer. In the end, we are all self-made. But only the successful will admit it. Richard Dennis.